outstanding!
Hello everyone! I'm Yana Stojanovic and I'm thrilled to have you back as we continue to explore what expats need to know when it comes to filing their taxes. Today, in part 3 of our 4-part series, we are again joined by tax expert and CEO of 1040Abroad, Mr. Olivier Wagner. Olivier will discuss today the famous word FATCA, what does it mean and who does it apply to. And we'll also take a look at renouncing citizenships when it comes to taxation and the obligations that apply. So stay tuned, we'll be back in a second. Olivier, now one serious question about a buzzword in the taxation world. So can you tell us what is the famous FATCA and who does it apply to and how long it's been around?
Well, it has been around for 10 years now. And we cannot really talk about FATCA without also introducing his cousin, the FBAR. So FBAR has been around since the 1970s. It required US citizens who have more than $10,000 in foreign bank accounts to file a report with the Treasury Department. It was not really enforced until 2003 when the IRS assessed penalties for people who failed to file FBARs, which was quite out of the blue because, again, there was no enforcement until that point. And so since 2003, people filed FBARs. And as you can imagine, $10,000 was quite a bit of money in the 1970s. In 2003, it was a smaller amount of money due to inflation. And so essentially, all of my clients have to file an FBAR. And then in 2011, Congress passed a law requiring foreign banks to disclose the information of their US citizen clients to the IRS. Well, there's two aspects of this. One was for the banks to disclose it, and the other one was for taxpayers to disclose it. And to everybody's surprise, foreign banks did comply with that US law, which has quite a bit of extraterritoriality applied in it, since they require the behavior of foreign banks. In any case, that has been the case for about 10 years now. Foreign banks have to identify their US citizen clients and send information to the IRS. Meanwhile, taxpayers have to include that FATCA form, which is Form 8938, to their tax returns. There are various thresholds. A single person living in the US would have to file it if they have more than $50,000 in foreign bank accounts, married, $100,000. If they live overseas, it would be $200,000 for single persons and $400,000 for married filing jointly. So these are thresholds that make more sense than the $10,000 for the FBAR, but the FBAR is still around. So we filed the FBAR and Form 8938 separately, which is a little. The thing is that Congress created that mandate for taxpayers to report their bank accounts that they have overseas when a mandate already existed through the FBAR. And they both get filed with the Treasury Department, the FBAR with FinCEN, the Form 8938 with the tax return, and therefore with the IRS. So they could have made it easier and connect the two and not require to submit the same information twice, but that's not the way the IRS implemented it. So if you have more than 10,000, if a US citizen has more than $10,000 in foreign bank accounts, they have to file an FBAR. If they have more than $200,000, again for a single person living outside the US, they would also file Form 8938, which by and large reports the same information.
Okay, so would you highlight for us what happens if an expat doesn't declare their FATCA?
What the IRS can impose fines starting at 50%, well, starting at $10,000 and up to 50% of the account balance. It's what these would be assessed with for willful behavior. Penalties were usually assessed for people who either went through great lengths to hide their assets. But before all of that was in place, Swiss banks were selling their services, highlighting the privacy laws of Switzerland. Obviously, that's no longer the case since FATCA. And a few years before FATCA, the US actually sued Swiss banks. And so banks were aggressively reporting their US citizen clients even before FATCA. In any case, so there are significant penalties both for an FBAR and FATCA. There are programs for people to get into compliance and avoid these penalties. If they have not filed a tax return, it will be the streamlined procedures, or if they have not filed for 38, streamlined procedures. Otherwise, they can file an FBAR separately, and the IRS wouldn't assess penalties if the income was already reported on the tax return. And the important piece that they do that before having been contacted by the IRS.
And what happens if person wasn't aware of their tax obligation and didn't handle it correctly? What would happen? Is it different for each country?
No, again, I prepare US tax returns, the IRS will implement US law. And again, they created the streamlined foreign offshore procedures to help people get into compliance. Right, so there is this requirement that the failure to file was not willful. The story usually goes that they moved overseas, they thought they didn't have to file US tax return. As it turns out, their home country operates on a residency-based taxation. They assume that the US was the same, which is the reason why they didn't file US tax return. Now that they became aware that was not the case, they get into compliance using the streamlined procedure. Right, residency-based taxation means that someone who's a resident of that country, who has ties to that country, who spent more than 183 days in that country, is taxed on their worldwide income, and non-residents are taxed only on income sourced in that country. The US is one of 2 countries in the world which operates on a citizenship-based taxation, which means that as long as you are a US citizen, you are a resident and you have to report your worldwide income.
And are there any horror stories that you are familiar with where an expat was in high trouble with their government, and how did that turn out? Can you share a story with us?
Yeah, I can think about this client who, I don't think he actually moved from the US. I think his parents were US citizens and he was born in Switzerland, lived in Switzerland his own life. He's a Swiss citizen, and a bank account with the post office over there. So in Europe, the post office also acts as bank, but they're not a prestigious institution. It's usually the everyday bank. They tend to target people with lower income. In any case, that bank, which happened to be the Swiss post office, froze half of their account balance until they filed US tax return, and that was the sort of things that happened in Switzerland in the 2 or 3 years prior to FATCA being passed.
Okay, and I have a hypothetical question. Say an American expat had not filed or paid their taxes and didn't comply with FATCA. Can they avoid being prosecuted or fined if they were to renounce their citizenship?
Well, no. So when you renounce your citizenship, you free yourself from any tax obligation from that point on, but you're not, that doesn't dissolve the obligation that existed when you were still a US citizen. And also, it's recommended that you file 5 years of tax returns prior to renouncing, else you will be a covered expatriate subject to the exit tax. If you make a gift to a US citizen or the US citizen inherits from you, they would be subject to a gift tax of 30%. Well, so that's definitely not a recommended course of action, and they wouldn't have any tax obligation for the years after they renounced, but it won't free them from their obligation, and the IRS could contact them for an obligation they had prior to renouncing. On a more practical level, if they don't have assets in the US, the US government's ability to seize their assets will be limited. There's been conversations about the US government seizing foreign bank accounts, because essentially every foreign bank has a correspondent office in the US, in New York, to operate international wire transfers in US dollars. And I saw some attorney making the case that the US would have jurisdiction over that office and therefore has jurisdiction over their foreign banks. And when the US asks a bank to seize money in one of their clients' accounts, typically the bank will take what is the easiest way for them. It's to comply as opposed to use their legal team to fight it. So I don't think it has happened, but that's one possibility that has been discussed, especially in this context of FATCA. Right, so in any case, tax obligations would no longer exist after they renounce US citizenship, but they wouldn't be freed from past obligations that existed prior to renouncing.
Being compliant is very important. Enforcement has become even stricter after enacting FATCA, and the consequences for not filing can be really hefty. A different filing can apply if a taxpayer owns foreign bank accounts and balances exceed certain thresholds, which Olivier mentioned. Luckily, the IRS has provided a streamlined foreign offshore program for those who are not fully compliant and for those who want to renounce their citizenship. For more information on this, you can visit Olivier's website at 1040abroad.com. In our final episode, part 4, we'll get some final thoughts on what expat needs to know when preparing their taxes. And we'll take a look at Olivier's book, US Taxes for Worldly Americans. So make sure you join us. This has been Jelena Stojanovic for Arpin's International Insights, the micro-series that's always moving for you. Take care and use every chance to stay informed.